Welcome to Market Catalyst. I'm Allie Canal. We're 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, tech stocks rally as OpenAI clinches a $500 billion valuation. More details ahead. Plus, the government shutdown continues. We break down what that means for the Fed, markets, and the economy. And gold's record rally powers on. How high can the precious metal go? We'll discuss. But first, let's take a look at the major averages because we are currently up across the board here. The Dow adding just around 100 points. The NASDAQ is up just around 0.3%. Pretty much on par with the Dow after that OpenAI investment. We are seeing chip makers across the globe really rally on that news. And then the S&P 500 just up slightly there. And remember that we saw record closes for both the Dow and the S&P on Wednesday. So anywhere we finish in the green, that would be yet another record close. The S&P 500 is currently on pace for its 30th all-time high for the year. And I also want to take a look at the moves that we're seeing in the bond market. We are seeing an ever so slight increase in the 10-year yield, pretty much nothing, just 1 basis point, right around 4.1%. 30-year yield hovering at 4.7%. And we've seen long-term yields be pretty range-bound as investors continue to price in that expected Fed easing. We'll be speaking with Kathy Jones. She's a head of fixed income at Charles Schwab about all of these moves within the bond market and, of course, the Fed. But in the meantime, chip makers powering higher today, adding roughly $200 billion in market value after OpenAI's $500 billion valuation fueled a global rally and reignited investor enthusiasm around the already red-hot AI trade. Joining me now, Nancy Tengler, Laffer Tengler Investment CEO and CIO. And Nancy, great day to have you on. I know you've been very constructive on this trade, but just your reaction to see the sheer momentum that we've had since those lows back in April and your outlook for the rest of the year.
Yeah, thanks so much for having me, Allie. I think what investors can learn from this experience is you have to actually jump in when it feels the most painful. We were adding to a number of the chip names in April. We were adding to Tesla. It wasn't easy to do, but if you believe that the technology is real, and we believe it is, then you use volatility as your friend, as a long-term investor. So I'm surprised, but not surprised. I think we're due for a bit of a pullback. We may not get one, but we usually get a correction about once every 12 months. We had one obviously in April, but we've run pretty hard and pretty fast. That said, it's driven by earnings. I mean, this is not a speculative bubble as we saw at the end of the 1990s. And I've drawn the analogy to the 90s for almost 4 years now in a positive way. This technology, however, is much more robust than the internet was and eyeballs on a screen, which was how we were valuing companies back then. So I'm pretty excited. We still like many of the names, and we hold almost all of the names, I think all the names you had up on the screen.
So volatility is your friend. It seems like you would advocate to buy any dips, but since we haven't seen a ton of dips so far, how do you play this space and find the most attractive opportunities when a lot of names are really at these record all-time highs?
Yeah, so we've been broadening out. We just launched a strategy that is a macro cycle opportunity strategy. So think quantum, space, robotics, AI, and nuclear, the leading technologies that will take us through this industrial revolution. But remember, these changes, these transformative periods can go on for a long time. And historically, the market has been concentrated in the names that are driving the technology. So if you own them, you want to hold them. If you get a dip, and we do. I mean, we were buying NVIDIA at $108 a share back in March and April. We bought Tesla at $240 a share. You will get pullbacks, and that's when you step in if you don't own them, or if you do own them to add to it. They will not, I mean, the market doesn't go up in a straight line forever. So we will see some sort of a pullback, and that's when you really want to just get in there and add to some of these names.
So what are those specific picks for you, Nancy, outside of some of those mega cap tech players that you were just referencing?
Yeah, so we have a few for you today, Allie. I mean, we've talked about on your air for a long time. Broadcom is the poor man's Nvidia. We still like it. It's one of the largest holdings in our ETF TGLR. Same, we'd still own Nvidia, love it. But one of the names we've held for quite some time, and we think has a ways to run, is Lam Research. So think global supplier of wafer fab equipment. They are dependent on memory, which had slowed, and now the cycle is beginning to pick up. Not just in memory, but NAND in particular. So cycle is beginning, and they grab about 2/3 of the NAND market. TSMC is one of their largest clients. Stock's up 100% or so this year, 102%. But you're getting paid a dividend that's about yielding about 7.7%, but growing at 15% annualized over the last 5 years. So you are getting paid to wait for the company to continue to perform. That's one of the names in chips that I don't hear a lot of people talking about. Another name in our new strategy is Symbotic. They are a robotics company that has really developed the back office of Walmart. Now, the downside is Walmart is 85% of their revenues, but the upside is they've been expanding their client base, and the CEO put in 800 or 700 million of his own money. So, and one of the important things I think to note about all of this is we've talked about Walmart as the poster child for old economy companies pivoting. The first customer to buy Symbotic software was Target, and then they decided not to go through with it. Walmart did, and you can see the difference in the stock price performance.
You've also flagged Spotify as a top pick, and we did get some news this week that they are going to be shifting to a dual CEO structure, similar to what we see with Netflix. Daniel Ek will be moving into that executive chairman role. What makes you so bullish on Spotify, and what's your reaction to that leadership shakeup as well?
So I think the leadership shakeup, Allie, was pretty well known. I mean, the two gentlemen, Soderstrom and Nordstrom, became co-presidents a couple of years back. This has been telegraphed. Eck is saying he's going to stay actively involved and be a European-style executive chairman, but they have room from a pricing standpoint to continue to grow. Monthly average users is expanding. It has run hard, and we have trimmed back our holdings, but it is still a member of our 12 best ideas portfolio, and we just continue to like it. I mean, if the economy slows, this is a company that continues to drive growth because it's kind of the last thing people cut, like Netflix in their budget. So we do still like the company. I wouldn't chase it here. I'd again wait, but we're holding on, and as I mentioned, it's in our 12 best ideas portfolio.
So how do you know when to trim back when stocks have run hard? Because again, we're in this environment where we just keep seeing higher highs.
Yeah, no. So if you're a retail investor, you don't necessarily need to do what I do because every sale has been a bad idea or trim because in a bull market. And so, but as a portfolio manager for institutions and large families, we have a commitment to not let the market make our asset allocation decisions. So, think Apple, we acquired it in 2013. If we had not trimmed it back, it would have been 15-20% of our portfolio at one point. So in the interest of diversification, we do trim back, but we run very concentrated portfolios, Allie. We have the 12 best, and then in our large cap strategies, it's max 30 names. So we do the research, and we make our decisions and overweight decisions based on the fundamentals and valuation to some extent. But it's the same with a name like Tesla. We have trimmed it when it got to current levels, but then we've bought it back. Generally, though, our core position has remained constant.
And there's been a lot of buzz around private markets after that $500 billion OpenAI valuation. Is private AI exposure something you've ever considered, or would you prefer to stick with those public names that have a bit more liquidity and you more disclosure as well?
Well, shout out to EquityZen. They've got a great model where you can go into their fund and they own actual shares in these private companies that, and the liquidity is, it provides liquidity for some of the insiders, which is a pretty cool concept. Think if you're in a company that takes 10 years to go public, it's great if your valuation, the stock valuation has quadrupled, but if you can't realize any of that benefit, it's not so good. So it's a win-win for the insiders and a win-win for private investors. We are in the process of starting our own fund through equities in order to be able to offer those shares to our clients. And the names I'm excited about are XAI and SpaceX, and of course OpenAI. But it's a new area, and I think it's matured enough that retail investors can get in.
Yeah, exciting time for a lot of investors right now. Nancy, thank you so much. Appreciate your insights as always.
Thanks, Allie.
Well, coming up, some of this morning's top analyst calls, plus with the government shutdown set to last at least 3 days, how investors should be looking at the markets. That's next.
Welcome back to Yahoo Finance. I'm Berkshire. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. Let's start with Mondelez, because that stock got a downgrade this morning. An analyst at Berenberg cut its rating from a buy to a hold. Now, the analyst said it's expected to benefit from falling input costs like lower cocoa and sugar prices next year, but weaker demand from consumers, who we know are extremely price conscious, are expected to weigh on earnings. Next up, we have Corteva. That stock moving higher this morning. JP Morgan upgraded the stock from neutral to overweight. It also upped its price target to $70 per share. Right now, the stock is around $63. And this comes after the company saw its stock price drop just yesterday on Wednesday after it announced plans to separate its seed and pesticide business into two separately listed public companies. And last up, let's take a closer look at Alibaba. That stock moving higher as well. JP Morgan raised its price target to 240 Hong Kong dollars. The analyst cited improved cloud revenue outlook and growing synergy between AI and e-commerce operations. And keep in mind, this stock has been outperforming year to date. The stock is up more than 120%. Certainly one to watch. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves.
Now time for some of today's trending tickers. We're watching Tesla, Rivian, and FICO. First up, Tesla. Shares soaring to a record high after its quarterly vehicle sales topped estimates. The company delivered a record 497,000 vehicles worldwide during the period. That's up 7.4% from a year ago. Investors recently looked past the first half sales weakness to Musk's promises of growth in areas such as driverless vehicles, artificial intelligence, and robotics. Tesla stock soared 33% in September, recouping early year losses with its best monthly performance of 2025. Next up, Rivian, narrowing its annual delivery guidance toward the lower end of its prior range. The latest pullback comes as the electric vehicle maker grapples with the loss of consumer tax incentives in the U.S. The company will deliver 41,500 to 43,500 vehicles this year. That's according to a statement. That compares with a prior forecast of as many as 46,000 vehicles. Rivian cut its forecast in May from as many as 51,000 deliveries this year. Finally, FICO. Shares are surging today after unveiling a major shift in how FICO scores are delivered to the mortgage industry. The new program gives mortgage lenders the option to calculate and distribute FICO scores directly to customers. Shares of credit reporting companies falling on the news. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, markets have fully rebounded from their April lows, with the S&P 500 notching its 29th record close of the year on Wednesday and now on pace for number 30. So, with such a strong start to Q4, how should investors be approaching this all-time high market? Here with more is George C., Annandale Capital founder and chairman. And George, I want to start there because you say we're not in a new normal, yet that's all I hear about these days, that AI is fundamentally going to change this market, the economy. So convince me, why are things not different this time around? And if history is our guide, what type of cycle would you look to really describe what's happening today?
Well, good morning. Thanks for having me on. I would just say that history doesn't repeat itself, but it does rhyme and it does echo, and there are ripple effects. And we sure are in a wonderful period of time right now where everybody's so optimistic, and it's really fun while it lasts and enjoy it while it lasts. But eventually these things all end at some point, and we don't really know what the catalyst for that is. And we don't know if that's anytime soon. So right now, just kind of enjoy the ride and make sure your allocation is appropriate and enjoy it until it ends, because they all end at some point. I mean, markets don't go up forever. So
if this is rhyming with history, then what should investors look for, the signs that they should watch to kind of tell them that the cycle might be turning?
Well, that's the hard part, isn't it? I mean, if everybody could predict when the next bear market's going to occur, when the recession's going to happen, we'd all get out in plenty of time and be able to time the market. And nobody's really been able to effectively time the market over a very long period of time. So it's hard to see things in advance and be able to get out appropriately. You really don't know if the 1% fall in one day is the start of something much darker or whether it's just a bump in the road along the way to higher highs. So there really isn't anything to watch for. I would watch for extreme signs of economic weakness if I was going to look at anything, though, and for the Fed to stop cutting rates. I think everybody's looking forward to the Fed cutting at least 3 more times, if not 4 or 5 more times, and they may not get that. So I think those are the 2 factors to really look out for. But it's really hard to time this. I'd pay much more attention to what your allocation is and whether your allocation is where it should be.
So let's talk about allocation. I mean, how should investors be thinking about risk tolerance and equity weighting as we head into the end of the year?
Everybody thinks they've got a really high risk tolerance until they start losing money, and then most investors tend to panic and get really upset. So I would just have less than 100% in equities, and whether that's 20%, 40%, or 90% depends on your age and your timeline and whether you're an institution or individual or so forth and so on. It varies for everybody. So I just take a hard look at that and make sure you're where you should be.
You mentioned policy, the Fed. We're in the middle of a shutdown. Markets historically tend to shrug this off. Clearly, markets are shrugging it off right now. But when you look ahead, when does that data start to rattle investors, or when does a shutdown length start to maybe creep in to visibility for the Fed?
I think I read someplace that the shutdown is going to cost 0.1% of GDP growth per week that it's shut down. So if you got to shut down for like 2 or 3 months, I think you start having an impact and people start getting sour about it. But right now, yes, most investors think the government's irrelevant and really doesn't impact the economy at all. And I think they're right. I think the government has very little effect on the economy unless the tax rates go much higher or government spending goes much higher. I think it's pretty much an irrelevant factor in terms of investing. And that's a good thing, actually.
And do you think that the Fed is on track either way for that October rate cut, even if we don't get that data like the non-farm payrolls report, which was supposed to come out tomorrow?
I'm not sure. I think Chairman Powell really doesn't want to cut a whole lot more. So I would not bank that for certain. I would watch and be wary because I think he's kind of tired of cutting and he's worried about inflation, and he's not as keen on cutting as the Treasury Secretary and the President are. So I think it's a bit uncertain. I think it's something to watch.
So are you worried about potential policy missteps from the Fed, considering inflation is still well above target? And if they do deliver those 2 rate cuts by the end of the year that they themselves forecasted, could that risk maybe reaccelerating inflation?
I don't think so. I think that maybe 5 or 6 rate cuts would accomplish that, but I'm not sure 2 really moves the needle that much. And I actually think the Fed's done a great job. I think that Chairman Powell started raising rates too prematurely in President Trump's first term and was scolded by the president. He quickly backed off that. And I think he was a little slow to fight inflation. I think that was his biggest mistake and the Fed's biggest mistake in the last 10 years. But other than that, I think they've done a really good job. I'm a big fan of the Fed, and I think they're performing their role very, very well for the economy and for the country.
And we have the Supreme Court set to hear the Lisa Cook case in January. We will be seeing a new Fed chair in 2026. What should we expect from the central bank next year?
Yeah, I think they're going to be very cautious. I think they're still worried about inflation, and I think they're worried about being typified as too easy and too low on interest rates. And so I think they're going to be very circumspect and very cautious, and I think they're going to try to stay out of the way and get a lot less attention, including all this war with the president over Fed governors and people voting on the Fed and Chairman Powell going away next year. So I think that they'd like a much lower profile, and I think they're going to get it at some point.
And is there a way for investors to use the Fed's expected moves in their positioning in terms of maybe equity allocations or even in the fixed income space as well?
Boy, that's a really good question. I think in the short term, yes. In the long term, no. Investors should just ignore that and pick great companies or great ETFs or index funds and just leave it alone and do as little as possible. I think that it's counterintuitive that I think investors, the less they do, the better. Just get your allocation right, get it in place, and just forget about it and go live your life.
All right. Good advice there, George C. Thank you so much. Appreciate it.
Thanks for having me.
All your market action straight ahead. Stay tuned. You're watching Market Catalysts. Tariffs weighing on automakers. Ford CEO Jim Farley had this to say on Yahoo Finance earlier this week.
It's frustrating because we're the most American auto company and we export the most, and yet we have this $2 billion headwind, which prevents me from investing even more in the U.S. I'm paying 25 to 70% tariff on those imported parts. It adds up to $2 billion. So that's what we're asking the administration for. Hey, help us.
Joining now with more insight into the tariff situation and broader auto landscape is Jacqueline McQuaid, GM's Global Vice President of Buick and GMC. Yahoo Finance Senior Autos Reporter Preston Romanian also joins us this morning. And Jacqueline, thank you so much for being here in studio. I want to get your reaction to what Jim Farley said about tariffs. How has GM been managing these increased costs, and what's the impact on your margins and the pricing of your vehicles?
Well, General Motors fundamentally is in a very strong position right now. Sales are growing. GM is up 10% year over year. GMC, which I have the honor of leading, is up 10% year over year as well. So we're in a very strong position. We did announce in Q2 an approximately $1 billion impact from tariffs, but we're working very hard to mitigate that. We also announced over the summer a multi-billion-dollar investment in U.S. manufacturing.
And as you work through these cost pressures, we're also hearing more about concerns when it comes to EV availability. That's something that Jim Farley talked about as well, saying that customers maybe aren't willing to pay extra for some of these higher end models. When you look at your sales of the Hummer EV and the demand there, what does that tell you about where the consumer is at?
From a GMC perspective, our demand for EVs has been growing month over month. We just had a record EV sales month in September. That was on top of a record sales month in August, which was on top of a record sales month in July. So the demand for GMC EVs is growing. And with the flexible manufacturing footprint that GM has, we can easily shift between gas and diesel powered and EV products depending on where the customer is at, so we can meet them where their demand is.
So, you guys operate in a very tough market here in the U.S. in terms of a competitive market, right? So, you got the GMC Terrains, the Buick and Vistas, which you're in charge of, operating that crossover space. What do you think is happening here with the U.S. consumer? What do you think is resonating with them with your products versus the competition in that really competitive space?
GMC is in a really unique position because we are the only truly premium truck and SUV brand. And we go across a broad portfolio. So if a customer is looking for a premium fuel-efficient, compact SUV, we have that in the GMC Terrain, as you pointed out. If the customer is looking for the ultimate EV super truck, we have that in the Hummer. And if they're looking for a flagship full-size SUV or the best pickup truck on the market, we have that as well. So that's what's resonating with our consumers, is the broad portfolio and the plethora of choices that we offer them.
So you talk about the Sierra, and there's a broad price range there from a more of a base trim all the way up to a Denali trim. We've heard about other automakers talking about payments, right? How do you manage a lease payment, or how do you manage that finance payment for a customer that wants to get into a vehicle? Is it longer payment terms? Can you do a little bit on the interest rate? Is that helping at all?
Well, there's a lot that we can look at. So first of all, to your point, we do go through a broad breadth, right? We have the Sierra Elevation all the way up to the Sierra Denali. So customers can choose what works best for their life, and that's across gas-powered, diesel-powered, as well as electric. And then you look at the residual value that our products command because of the quality and the premium nature of our products, and that helps with lease payments as well.
And you were talking about the optionality for consumers, and I'm just curious, within this environment where we have sentiment really low, we still have a consumer under that pressure for inflation. Have you seen interesting patterns when it comes to maybe more customers going for those cheaper models?
Well, it's interesting because when we look at the customer's desire for GMC's higher end trim, a decade ago, we were selling maybe 20% of our products at our highest trim level. Today, we're selling more than 50% of our products. In fact, Denali just had its best sales quarter ever, and Denali, of course, being our highest end trim. So what customers are telling us in the GMC space is they value the premium trucks and SUVs that we produce. They consider them to be the right choice for them. But again, we also have 50% of the customers choosing those more entry-level trims. And so it's that value we give the customers, this optionality of choice across our trim levels, that's really resonating, and it's why GMC is on pace to have its record year.
And maybe it's kind of indicating the higher consumer is still doing well in this environment.
Right.
I kind of want to pivot kind of globally, because you're in charge of the global business and China. GM's had some growth there in the years in the past, and is sort of retrenching a bit, but also trying to grow again. You're in charge of Buick, which is big in China. What's sort of the overall take in that region right now for GM's exposure in the region?
We're doing exceptionally well. We've had a great year. The team over there is really focused on the business and really getting the business to where it needs to be from a strength perspective, and I think they've done a fantastic job.
And you mentioned EV sales hitting a record. We do have that federal EV tax credit expiring, but GM is doing something interesting. They're extending that $7,500 discount for leased vehicles. Why make that decision? Does that have any impact on profitability at all?
Well, I think that's been widely reported, so I really don't have anything more to share on that. I will tell you that from an EV adoption perspective, we do anticipate that there's going to be some ups and downs in terms of the trend of growth, and that's typical for any new inventive technology. No new adoption of a technology is ever going to be fully linear, but our flexible manufacturing footprint allows us to respond to that very well between production of gas and diesel powered and production of electric.
For me as a person who likes performance cars, GMC obviously is a truck brand, but Buick, in the past has had performance-oriented cars. Are we ever going to see more sedans and cars of that nature in the Buick line, or is it always just going to be crossovers?
Well, I can't really comment on the future product portfolio. That's something
you worked at Milford, though. You worked at Milford,
I did. My background is actually engineering and performance, and I did spend quite a few years at our proving grounds in Milford, and it's been a great experience and something that I absolutely pull into this role, but we've got to keep that future product portfolio close to the vest.
All right, so you can't tell us how you're positioning the brands maybe into 2026?
Well, when you look at GMC has always been positioned as this premium truck and SUV brand, really the only premium truck and SUV brand on the market, and it's doing an exceptional job for GM.
All right, well, so much to look at in this space overall. Jacqueline, thank you so much for joining us, and of course, our own Pro Supermanian as well. Well, coming up, how retail traders are approaching the market right now. Stay tuned. You're watching Market Catalysts.
Investopedia's most recent sentiment survey showing AI bubble and inflation concerns in part fueling skepticism among retail investors regarding their investments. For more on how individual investors are approaching the market right now, we welcome in Investopedia editor-in-chief. That would be Caleb Silver. Caleb, always great to see you. So big picture, it sounds like folks are still broadly optimistic, positive, but maybe is it skepticism bubbling up here? What's going on? What's driving this?
I think we cue Mel Brooks here because it's a little high anxiety. Market at record highs, valuations
Phenomenal reference.
Valuations at record highs, concerns every which way you look, whether it's the economy, whether it's the dysfunction in government, whether it's the fact that prices are rising, the labor market's slowing. Everywhere you look, there's things to be concerned about and wondering right now if things gotten a little too high, given where prices are, given these record highs we've had lately, despite all of the worries.
On the AI bubble talk, I'm interested to get you've been watching markets for a long time. It's interesting to watch, you saw Ken Griffin, David Einhorn, these are smart guys, kind of throwing some red flags here on all the AI spending. Do you share those red flags or no, you think, since I've had other guys on the show this week, it's transformative. It's going to be bigger, they told me, than mobile, bigger than cloud.
Yeah, it is bigger because this spend requires a bigger degree of dollars. So when you're talking about a potentially $10 trillion spend out on building AI infrastructure, there's a lot more room to run here. And there's been comparisons to 1999, of course, but there was a lot of companies that weren't producing any revenue, that weren't producing any profits in that era. So there's still a build out here. The question is, have prices got too high? Look across every traditional metric, price to sales, forward PE ratio, the CAPE ratio, all the classic Investopedia terms that people look at when they look at fundamentals, and those all look screaming high right now, and you even heard the Fed chair.
Chair Powell said, he suggested we're kind of stretched.
Yeah, a little near irrational exuberance again on the one hand, but at the same time, these companies are stacking profits like we've never seen before in terms of what companies have been able to do on a quarterly basis, on a year-end basis. And when we're measuring a lot of those classic fundamentals, we're measuring them out 12 months. Well, these companies are building for the next decade. So if you look at it that way, maybe we're just in the middle of a very big spend, and this carries on for a while. But you can't help but worry a little bit about valuations right now, and you can't help but worry about the fact that the stock market's doing great. Capital markets, especially the risky part, is doing very well right now, while the economy doesn't seem to be doing all that well.
For Investopedia folks, what are their top holdings?
Their top holdings look very much like the top of the NASDAQ 100. NVIDIA is the top stock in almost all of their portfolios right now, surprise, surprise, but you also have Apple there, you also have Microsoft, you also have Alphabet. You also have companies, that Palantir is big in their holdings right now, and Microsoft. And when we ask them what they're holding now and what they would buy and hold for the next 10 years.
Yeah, where do they want to put money to work?
It looks very similar, which concerns us a little, me at least, because we're all kind of piling into the same things. But when you look at the top performing stocks so far this year, none of them are on that list except for Palantir. So a lot of everybody's piling in to the same safety stocks that they've held for a very long time, probably sitting on gains and loath to sell them or try to transition to another sector, to another part of the market. Though we did see international stocks climb in terms of people's attitude and what they're buying lately, what they're doing with their money, and also gold. Renewed interest in gold with gold at a record high. Welcome to the party, but now they're getting into it.
That's interesting. I mean, gold enjoying a blistering run. So that made their list. Was that a shift? That interest in the metal or no?
When we asked them, what would you do with an extra 10 grand if you had it to invest? Their top three choices are individual stocks, and it's kind of been that way for the past, 6 to 7 months. ETFs, which is more of a diversified safety play there, and then gold. First time gold cracked the top 5 in the whole time we've been doing this survey, and we started this back in 2020.
Did you survey their thoughts on the Fed?
Yeah, we asked them about the Fed. Did you think the Fed is handling monetary policy appropriately? Most people said yes. Do you want the Fed to remain independent? 79% said absolutely yes. Very important to Investopedia readers who are all individual retail investors that depend on the trust and the veracity and the independence of the central bank, but also they want to trust this government that they're going to do the right thing for their portfolios.
On their list of worries, did tariffs bubble up?
Tariffs is number one on that list. Tariffs and reciprocal tariffs, followed by inflation, and then they're worried about the accuracy of government data. That comes into full focus this Friday.
That's interesting.
Yeah, these are traditionalists who like things the way they are. They want to be able to look at data, make their investing decisions based on what's happening in the economy, based on fundamentals. If you can't trust the data, if you can't trust what you're hearing from our government agencies, it's really hard to invest in that type of an environment.
I want to get your thoughts on the government shutdown. Now, clearly, we were talking off camera. The market seems to be shrugging this off. Are you surprised by that reaction?
No, I think we've gotten pretty used to government dysfunction when it comes to investing and what happens in the stock market. We've had, 5 of these over the last 10 years, and guess what? The market's been higher every single time. And when these things end, when they finally do end, the market usually shoots up again after that. So I think investors have brushed that off. They're used to this. They're focused on corporate profits that are continuing to grow. They're focused on the fact that interest rates are going down and to the right, and they're focused on the fact that this administration is very light on regulation, so they're out there printing profits.
So I have the bulls come on here, and here's what they say. They say, listen, to your point, they'll say, earnings are solid, the economy seems to be hanging in there, the Fed's cutting, so I'm staying long. Do you agree with that? Is that too simplistic? What do you think?
It's been the right trade, and if you haven't done that, now you're catching up to it. Now your clients, if you're a professional money manager, are saying, where have we been? Why have you been kind of bearish this entire year? Market's up 24% since April 9th, up 13%. And
so now what, a year-end chase?
Yeah, well, I spoke to Dan Niles recently, a very smart analyst and an investor who we both know, who said there's going to be a lot of window dressing going into this month, and then maybe in the next month. Come the end of the year, though, things could get a little bit dicey. Because
Why do you say that?
Because he does feel like global fund managers who have been mostly bearish all year until very recently have shifted to bullish, and their clients are asking them, where's the performance given the outrageous performance of some of the
I see the fee, where's the performance?
Exactly.
Fair enough.
Exactly. That's what the money's for.
Caleb, always great to see you.
Thanks for having me.
Thank you, sir.
Investors continue to flock to safety, pouring money into commodities and helping fuel the recent rally in gold. So where do prices go from here? And what's the playbook for investors looking to get in on the move? I'm joined by Aakash Doshi, State Street Investment Management Head of Gold Strategy. And Aakash, we've seen this rapid rise in gold. Goldman Sachs is out with a new note. It now sees a path to 4,000 by mid-2026. And you said your team could raise its own bull case range to 3,900. So what's been driving this move, and is it sustainable?
Yeah, Allie, in fact, earlier this week, we already highlighted that $4,000 an ounce is not only a question of if, but when. And we do think that that's plausible this month, or certainly in the fourth quarter, assigning a 75% probability of breaking above $4,000 an ounce. Where we go forward from there, there could be some modest retrenchment. November and December are negative seasonals for gold ETFs in particular. But overall, I think the structural and macro tailwinds supporting the yellow metal this year is likely to continue into 2026, and that it's more likely that we see $5,000 an ounce gold rather than $3,000 an ounce gold in the next 6 to 12 months.
Yeah, and what's kind of fueling that? I mean, we do have equities at records at the exact same time, and that's pretty unusual to see.
I see that as a very positive for gold because the S&P 500 has rallied to a record level since the mid-April swoon following the tariff announcements. But gold has held its own. It was only down 3 to 4% from all-time highs throughout the summer. And then going into the end of third quarter, we really saw the move above $3,500 an ounce. And now, as we're speaking today, above $3,800 an ounce. And I think a big part of that has been a weaker dollar. It has been strong physical demand from China and central banks. Really record ETF inflows in the month of September in particular. We saw over 10 billion in US listed ETF gold inflows. And that has really supported the market. The gold was an underowned asset in 2024, despite its stellar performance last year. And it was really even underowned earlier in 2025. It's only in the last 3 to 6 months that investors have caught on. I think going forward, with all the risks emanating out of the administration in Washington, D.C., with all the uncertainty around inflation and Fed policy, gold is really benefiting from an uncertainty premium. And the fact that stocks haven't sold off in this recent rise, to me, that adds to gold's appeal as a volatility and safe haven hedge should that occur over the next 3 to 6 months.
And for investors watching this move, what's the best way to gain exposure into gold? Is it through ETFs? Is it owning physical gold, or maybe something else?
Well, physical gold has often a wide bid-ask spread or transaction cost. You have to pay for storage and insurance. So really the ETFs, and State Street Investment Management has the SPDR ETF suite, the largest on the planet, GLD and GLDM. Really, they have low transaction costs. You can trade them in your brokerage account. They have high liquidity and really high transparency. The shares are backed physically by gold that are stored in London vaults. And it's a really clean and efficient mechanism, we think, to have gold exposure in your portfolio.
And what's the ripple effect here as gold prices climb? I think of things like gold mining. Are you seeing more attractive opportunities in maybe some of those equities?
Yeah, gold mining stocks have been a big catch-up trade this year, actually even outperforming gold over the year to date. However, I would say in the medium term, if you want gold exposure in your portfolio, gold mining stocks do not serve that purpose. They're still tied to company management, cash flows, dividends. They have a lot of upstream capex costs. So there can be a lot of winners and losers in the space. Having gold in your portfolio is providing that traditional, low volatility, uncorrelated asset that really protects you from drawdowns, provides a heightened amount of liquidity during liquidity squeezes, and really is providing you that portfolio diversification that I would say even the mining stocks in the gold sector do not.
And beyond gold, what's your outlook for other precious metals and industrial metals like silver or copper? Are there opportunities there for investors?
Well, I think silver has been quite a catch-up trade. If you look since mid-2025, it's actually even outperformed gold. And I think that's for tactical reasons, because for the prior 6 to 12 months, silver had actually been underperforming gold before mid-2025. I think if gold gets above $4,000 an ounce, which I think is inevitable over the next few months, then I do think silver could test $50 an ounce. But this recent rally in silver that we've seen has only brought the gold-silver ratio back to its post-pandemic average. So I do think because central banks are buying gold, because there's so much geopolitical and policy uncertainty in the U.S., now you have the labor market weakening. We're not even getting labor data tomorrow for September payrolls, but we saw the ADP print earlier this week suggesting a slowdown. I think gold is still your safe haven hedge. Silver is a catch-up trade, but still very tied to industrial activity. So if we do get the S-word stagflation or the R-word recession in the next few months, I think gold will take its leadership away from silver over the subsequent year.
Yeah, and those are very scary words, Aakash, so hopefully we don't hear those. But thank you so much. Appreciate your insights.
Anytime, Allie. Thank you.
Well, coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst, first up, we'll break down what the government shutdown means for investors. Plus, Buffett inks a $9.7 billion deal with Occidental. Details ahead. And Tesla sees record sales soar for the latest quarter. We'll discuss that and more on Market Catalysts. We are 90 minutes into the start of U.S. trading. I'm Allie Canal. Let's get a check of the markets. And we are seeing some downside pressure in both the Dow and the S&P 500. They're both off roughly 0.2%, reversing some of the gains that we saw earlier in the session. Remember, both the Dow and the S&P secured record closes on Wednesday, so seeing a bit of pullback there. The Nasdaq, though, still slightly holding on to those gains, trading just flat here on the heels of that OpenAI valuation news. Well, the 10-year Treasury yield holding steady as investors weigh how the ongoing government shutdown could impact the Fed's plans for 2 more quarter-point rate cuts before year-end. Joining me now with more on what this means for fixed income investors, Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. And Kathy, thank you for being here. Let's start with what the bond market is telling us. I mean, we've seen yields go sharply lower as investors continue to price in expected Fed easing. But now with the ongoing government shutdown, the still unknowns when it comes to inflation in the labor market, what should we glean with what's potentially to come?
Well, it's a real problem without the government data. We have private sector data that's giving us some information, but it's not at the level that the government data is. So we're a little bit in the dark, flying blind here, as is the Fed. I think, though, the longer the shutdown goes on, the less economic activity there is, the greater the risk is that we have a downturn in the economy, or at least a much softer economy in the fourth quarter. And that could lead the Fed to cut twice rather than the one time that we expect. But it's really fluid right now because you have conflicting signals. The Fed's dual mandate is in tension. Inflation's too high and edging higher, and growth is in the labor market is slowing and looks like it's getting worse. So that's in tension. And without information to inform us as to how the economy is going, we're kind of left here in the dark. And I think the bond market's kind of reflecting that. It's just sitting in waiting in a narrow range, waiting for something to happen.
You mentioned that we do have access to that private sector data. What data points are you looking at? What data points is the Fed looking at, given the fact that we're in the dark when it comes to that government official data?
Yeah, I was looking at this ISM data. We looked at the ADP employment data yesterday, consumer confidence. And I think what it continues to tell us is we have an economy that's running on 2 tracks with, wealthier people with higher incomes doing fine and continuing to spend. And in aggregate, that's keeping the economy growing, like consumption. On the other hand, you have a lot of softness in the labor market, particularly for younger workers or for people who traditionally have had a harder time finding employment. So you've got 2 different tracks going here. And the consumption level is holding up GDP growth, but the weakness in the labor market could lead to, a significant downturn the longer this goes on. And not the least of which is if the administration succeeds in firing a bunch of federal workers, that's going to send the labor market into even more of a downturn. So Fed has to watch these numbers. They take a number of surveys. Every Federal Reserve Bank has surveys monthly in their district. They're going to pay a lot of attention to those numbers because that's data that they can gather and that's their constituents. So we're just going to keep an eye on this. My bet is that they do cut rates another time in the fourth quarter, maybe twice. But that inflation data, inflation pressure just doesn't look like it's going to ebb anytime soon.
Yeah, and I've been having that conversation with a lot of folks out there that inflation, it's really not going in the right direction at this point. We're still significantly above the Fed's 2% target. And some have told me that markets may be accepting the fact that we are just in this 3% range higher for longer. Do you think bond traders believe that as well?
Well, I think that's what's being priced in. But I'm not naive enough to think that the Fed is just going to say, okay, we'll take 3%. I just don't think that that's something that they are willing to do. They basically have to change their mandate. So if you're betting on the Fed just throwing up its hands and saying, well, we can live with 3%, I think you're making the wrong bet. You're betting on too many rate cuts in this cycle. My guess is that the Fed is serious about getting inflation down to 2%, will accept some rise in the unemployment rate if they see that as creating enough slack to get the inflation figures to come down.
And Yahoo Finance got the chance to sit down with Rick Wurster, Charles Schwab CEO, and he said he's seen more retail investors looking into bonds. Kathy, I want to get your reaction to what he told us on the other side. Take a listen.
The other thing that's come up more recently that we're seeing from retail investors is a renewed interest in fixed income. Well, what's happened is with money fund yields coming down, investors are asking, hey, should we be in a bond strategy that has a little bit more duration to it so that we don't run into this reinvestment risk issue? So we are seeing bonds be of more interest to investors.
Hey, bonds a bit more interesting. Are you hearing the same thing from your clients, and what are you advocating for when it comes to positioning?
Yeah, we've been advocating for not sitting in cash for a long time because of that reinvestment risk that Rick mentioned. We also, though, don't want them to take too much interest rate risk and go too long on the yield curve. So we like intermediate term duration as an average duration, so which means you could spread it out and just end up with the average in that 5 to 10 year area. We think that that gets you enough yield without the reinvestment risk and without a lot of interest rate risk. And also, though, we're advocating staying higher in credit quality. It's not that we don't like lower credit quality bonds per se, but we're not getting paid a lot extra to take that extra credit risk. And if the economy slows down, we could see that underperform. So we like high credit quality bonds, government securities, investment grade corporate bonds, investment grade municipal bonds for people in high tax brackets in that sort of intermediate duration place, because we think that that's going to perform best in this environment.
And Kathy, you and I have talked before that if the bond market's boring, that's pretty good. That means things are going okay. If you start to see a lot of activity, though, that's typically a sign that something's not going right in this market, right?
Yeah, absolutely. Bonds will react if we have a big sort of change in the outlook. If it's a slowdown in the economy that even risks recession, you could see the long end really rally. If it's an acceleration that gets the employment numbers jumping back up and keeps inflation high, you're going to see a sell-off. So right now we're kind of in an equilibrium that's not too bad. And you can earn your coupon, maybe get a little bit in capital gains. It's a good environment for a bond investor if you're staying in the better credit names. But, that lack of volatility never lasts forever. We always have episodes. So, we'll wait and see what happens. We certainly have enough activity going on in Washington to give us the potential for volatility coming up in the next couple of weeks.
Yeah, plenty of risks heading into the end of the year. Kathy Jones, always a pleasure speaking with you. Thanks so much.
Thank you.
All your market action straight ahead. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Berkshire. We're live at the NASDAQ here in Times Square. Let's get a quick check on the latest market action. We're about 2 hours into today's trading session, and we're seeing a bit of a mixed reaction on the street as day 2 of the government shutdown continues. Investors largely shrugging it off, but we are seeing some downward momentum this morning. The Dow down nearly 0.3% as we started in green this morning. The NASDAQ trying to hold on to some momentum here. We did see it slip into the red just ever so slightly, now about 9 points higher as investors really get this renewed optimism around the AI trade when we got that $500 billion valuation around OpenAI, and the S&P 500 also trying to hold on to some momentum here, but we are seeing some downward pressure, down about 0.2% after they closed at their 29th record high and surpassed that 6 6,700 mark yesterday afternoon, trying to hold on to that momentum here, but we are seeing it fall down about 12 points this morning. I also do want to switch over to gold futures because that's something that has gotten so much attention this year. Year to date, gold futures have seen an incredible record of up nearly 45%. But now today in intraday trading, we are seeing some downward momentum flip into the red, down about 1%. Investors largely seeking out gold as a safe haven in this market. We also are seeing some downward pressure on silver. That has also seen quite the run year to date, up more than 55%. But once again, going back to that renewed optimism around AI, we did see Nvidia, Broadcom, and AMD move higher today. Nvidia, Broadcom, and AMD also holding on to that momentum. We are seeing that continue into today's trading session after Nvidia has really seen that run this year off those April lows, up more than 40%. We also do see some downward pressure when it comes to Microsoft and Tesla, despite that beat. Besides that beat on Q3 production and deliveries, we are seeing some downward pressure after it has seen quite the run over the past month, up more than 37%, returning to where we started this year and now surpassing that. But we are seeing some downward pressure today, down more than 1% despite that beat. But largely, we are seeing a bit of a mixed picture here, taking a step back, looking at all three major indices. We now do have some downward momentum, the Dow, the S&P 500 moving lower, while the NASDAQ largely remaining flat. But keep it right here on Yahoo Finance. We'll be tracking all the latest market moves throughout the trading session.
Warren Buffett's Berkshire Hathaway reaching a $9.7 billion deal to buy Occidental Petroleum's petrochemical business in cash. Buffett's biggest move since acquiring insurer Allegheny. It's a sign he may be ready to put that record cash pile to work. Joining us now with more is Miles Udlin, Yahoo Finance head of news. Miles, thanks for being here.
Thanks for having me.
So Warren Buffett back on the hunt here. I mean, what does this tell you about where he maybe sees value right now?
Well, I think the most notable part of this deal is if you look at the press release, his name is not anywhere to be found. And let's not forget, Warren Buffett will not be the CEO of Berkshire Hathaway come the end of this year. Greg Abel, who runs Berkshire's non-insurance operations, he will be stepping in as the CEO of the company. He is the person who is quoted in this release. Now, you know, the OxyChem business is going to be folded within that Berkshire Hathaway, again, the non-insurance operations, and they have Berkshire Hathaway Energy. There's other reasons why I think those synergies make sense, but I think this deal, just in that context of like, what does Buffett see? I think it's worth being like, all right, it's October 2nd. He didn't really see anything. You know, like, I mean, obviously he watches all this stuff and he has an opinion on this, and he spearheaded the investment in Occidental Petroleum, which they now own about a third of that company, a little bit less than a third of that company. But when you look at the go forward for Berkshire Hathaway, I mean, we've known this since May, and I think people kind of got a sense that this is where things were headed over the last few years. But seeing this deal come through and thinking about it in the context of what it means for Berkshire, I think the first thought that I had is like, well, this is not that Warren Buffett wouldn't have done the deal, but it's like, this is not Warren Buffett's company anymore.
Right. So what does that say maybe about the leadership of Greg Abel? And is Berkshire going to be a little bit more offensive, considering the fact we do have that record cash pile? Yeah. Buffett was trimming his stakes on Apple. So it feels like maybe more deals to come.
Well, I think what's interesting about the reaction in Occidental stock today is it's down. And I think it's because people are like, oh, I guess they're not going to buy the whole company, which had been the thought for some time. Now, Buffett came out himself and was like, I'm not buying the whole company. But he continued to buy up a larger and larger position in Occidental Petroleum. He has a preferred position there. He has a bunch of common. So again, owns about a third of the company. By buying a unit and folding it within Berkshire, couldn't be clearer that he is not going to buy, or that Berkshire Hathaway is not going to buy the balance of Occidental Petroleum. But I think, I'm not sure if anyone has a great feel, to be honest, for how Greg Abel is going to be thinking about the cash pile for Berkshire going forward, other than what Buffett himself said in the letter last year in February, which is like, yeah, I know we got a lot. Sorry, that's all I got for you. I mean, I think it's possible, like Buffett has been very clear over 60 years. Not a dividend guy, does not like the tax efficiency of a dividend. That's why he likes buying back stock when he wants to return capital to shareholders. And I think the tax treatment of buybacks for shareholders, which there really is none because you just own a larger percentage of the company if you don't do anything as an investor, it's more advantageous than paying out a dividend. Is that something Greg Abel might consider in the years ahead? Possible, but it is. This is a company that's what, 8th, 9th largest, 6th, something. Like it's in that $1 trillion-ish range, depending on where exactly the stock is sitting. And they're having a change in control from a founder CEO basically to a new CEO who's from the operating business. He's not as inclined on the investment side as Buffett was. And so, sure, there may be some breadcrumbs in here around trying to figure out what Greg Abel's Berkshire Hathaway may look like. And I think a big question with that is how you're going to use $300 billion in cash. I don't know, like I'm sitting here teeing up the end of the year, looking to next February with that letter, and I'm like, I'm not sure if I'm going to read too much into this other than this couldn't be a clearer statement that they're not going to own all of Occidental, which again, he's said, but people are always kind of like, maybe, but definitely not.
I mean, Berkshire shares have done well this year. I mean, they're up around 10%, not quite outperforming the S&P 500.
Well, they've done worse since Buffett said he was leaving.
Right, exactly. And even during those April tariff lows, I think Berkshire is one of the only ones that was kind of doing okay amid that volatile environment.
Yeah, I mean, I think again, it's an interesting company in that, I guess the way I would say it is that now we're talking about Berkshire Hathaway.
Yeah.
And I think that this whole, and I think about my whole career in covering the company, covering Buffett is like, that's the thing, right? There's this whole ecosystem around covering Warren Buffett. He's got the writing, he's got the books. It's like, he's the draw.
Right.
And now it's like, okay, what are we gonna do with Berkshire Hathaway? Like, is this an industrials coverage? Like, mostly the analysts who cover it are insurance analysts, mostly. But there's not a ton of analyst coverage. So it's like, does Greg Abel change the cadence around communicating with the street? It's just very interesting to see a company that is this large, biggest component in the XLF ETF, a company that's this large, going into an executive change that literally has never happened before and won't happen again when given Buffett's status within the overall market, et cetera, et cetera. So I think it's an interesting deal, mostly in the context of Berkshire Hathaway and like, what does this company start to look like going forward when it isn't teed up as Warren Buffett's Berkshire Hathaway? It's just like, oh, that really big company that's based in Nebraska.
Yeah, no, it's a great point. And I do think investors are really curious what the future will look like and how Greg Abel is going to steer the ship.
And I do wonder, look, Warren Buffett's Berkshire Hathaway, that's SEO, right? That hits.
Oh, yeah.
But
here he goes, bringing in his day job.
Hold on, but come February, it's like, I guess you could say it, but like...
They're not there anymore.
I know,
it's true.
Maybe we should go back and think about when did we stop referring to Amazon as like having a Jeff Bezos tie-in,
okay.
Right? Like
would that be the equivalent then? I guess you could say Elon Musk, Tesla.
No, because he's still there.
He's still there. Yeah,
so that doesn't work.
I think, Jeff Bezos might be...
Like, and this kind of predates our time working together. Like, when did it stop being Bill Gates' Microsoft kind of thing? But it's that idea of you view this company as the extension of a single person, and that's not going to be the case. It's not the case now. Again, that release does not mention Buffett at all. Greg is really steering that strategy. He's going to be making decisions on allocation, and I think it's going to be very interesting to see, if at all, the extent to which he kind of veers from the path that Buffett set.
Yeah, and to keep up with that Amazon comparison, I do think Andy Jassy has elevated himself to a level where you at least know who he is, but not at the same, I guess, pedestal that Jeff Bezos was at.
Well, we know who he is.
That's true.
But
I guess we're a little skewed.
I mean, just like going on the street, All
right. Well, we can keep talking about this. They're telling me to wrap in my ear. But Miles, head of news of Yahoo Finance, thanks so much for joining us.
I didn't know how much time you needed, so there you go.
All your market actions straight ahead. Stay tuned. You're watching Market Catalysts. Tesla surprising Wall Street, reporting a record number of deliveries in the third quarter, coming in above 497,000 and more than 7% above the mark set during the same period last year. The end of the third quarter also coinciding with the expiration of EV tax credits. Were the Tesla numbers the result of consumers rushing to beat the expiration? And what can we expect from Tesla and other EV makers post-tax credits? Let's bring in Brian Moody, Kelley Blue Book Executive Editor. And Brian, I want to start with those Tesla delivery numbers. Surprising to the upside, yet shares are down just around 2%. So what's your reaction to what we heard this morning?
Well, one thing investors may be responding to is that this is a temporary bump because of that federal incentive. Remember, that's a taxpayer-funded incentive for EV purchases. At the same time, we sold plenty of Teslas before there was an incentive, and my guess is we'll sell plenty after. Same with other electric car makers. Only now, the lack of the incentive is going to have to make people want to buy those cars based on their own merit, not because they're going to get a big discount.
So let's talk about the expiration of the EV tax credits. I mean, are there companies that are more exposed to this than others? I mean, my head goes to Tesla because it's that pure play EV giant. But are there ways that maybe they can rise above that expiration?
Yes. What we've seen from Tesla in the past is when they lower prices, orders go up. And I think that is a trend for the overall industry. It's very telling that we're talking about the removing of a taxpayer-funded incentive for electric cars. And at the same time, what's happening? We're seeing record Q3 sales results. August and September, I think it's going to end up that electric vehicles overall made up about 10 to 12% of the market during that time. What that tells us is that product is priced too high. When you remove price, that's a barrier. More people want one. So what's going to have to happen for automakers going forward is they're going to have to find a way to right size the price for those vehicles, Tesla included, to get more people in the seats of those cars.
And to that point, we are seeing certain automakers respond with deeper discounts. So could there be a world that maybe we have a steady decline in these EV car prices and it doesn't even matter if we have these government subsidies or not?
Yes, that will definitely happen over time. One thing that's going to happen in the meantime, though, is you're going to see models go away. Certain automakers that said they were all in on a fully electric fleet by, say, 2025 or 2030, some of those models are going to go away. But at the same time, the prices on some of these electric cars, the good ones, will rise to the top because without this incentive, now people want it to make sense on value, features, durability, and cost effectiveness. So we'll see prices come down over time, mainly because that's what happens with technology, right? As time goes by, technology becomes more affordable. Think of something like consumer electronics, phones, and big screen TVs are perfect examples.
And from an investor standpoint, should we expect a dip in Q4 auto sales, given the fact that buyers were front running a lot of those purchases to lock in those incentives?
Yes, that's almost likely going to happen just because of simple math. You had all this demand as they rushed to beat that price incentive, and it's only natural that it's going to drop off a little bit, maybe even as much as 50%. Now, some automakers, we are hearing that Ford and GM may have found a way to give pre-down payments on cars that they know they'll sell even before they have a buyer for it by using their financing arm. So that could help boost the sales of those cars into Q4. But for the most part, you're exactly right. The sales are going to drop temporarily. I think over time, they will bounce back to their right place.
And as we see consumers maybe become a bit more choosy about the types of cars that they're purchasing for both gas-powered cars along with EVs, what's the used car market been like? And how does that compare to some of these newer vehicles on the market?
Well, one thing we know is that electric cars tend to depreciate very rapidly. So whenever you see analysis of the cost to own, factor in initial purchase price and depreciation. The good news for consumers is that if you're looking for an electric car, a used electric car will be an amazing bargain. Like, they are really competitive in terms of pricing. But at the same time, you get lots of compelling features and you get lots of cool safety equipment. So it can work out for consumers if they're looking for a good used electric car.
And finally, for shoppers looking to buy or trade in, end of year is usually that time that we see the most deals, the most tax incentives. Is that still the case this time around, or did that playbook change a bit with the expiration of these tax credits?
I think there's several things putting pressure on that. Of course, you're going to see a little bit of that. It's going to be model by model, not brand by brand. But the two things that we're seeing is the expiration of the incentives plus tariffs. All of those things could have the potential to make the 2026 cars more expensive so that you may be able to get a discount on the 2025, but that's probably it. Going forward, not every automaker can afford to absorb the tariffs as many are doing right now.
All right, Brian, a lot to think about as we head towards the end of the year. Appreciate it. Thanks so much.
Yes. Thank you.
Well, the Trump administration is imposing tariffs on furniture as part of an effort to boost U.S. manufacturing. Yahoo Finance's Josh Lipton spoke to the CEO of Ethan Allen about the company's domestic manufacturing. Take a look.
Farouk, it is great to see you. So, listen, we know, Farouk, the president has been making headlines with these furniture tariffs. You have been working in this industry a long time. You've been at Ethan Allen a long time, Farouk. So I'm curious to get your take. We know what the president wants, Farouk. He wants more stuff made here in the United States. Are tariffs the right way to get it done, Farouk?
Well, first of all, it's good to be with you and on the program. I think the objective is a good one. And as you said, it's a question of how to do it. For instance, when we decided that we would maintain manufacturing in the United States, and it was not easy. We had to then say, United States alone would not be the right for us. We went to North America. I said combining the benefits of overall North America is what would give us an opportunity. So we first, about 22 years back, went to Mexico, the south of Mexico. Then, about 12 or 14 years back, we went to Honduras. By combining what we're doing in Vermont, what we are doing in North Carolina, what we are doing in Mexico and Honduras is what makes it feasible for us. If we had not done it, it would have been very hard for us to maintain manufacturing in the United States. For instance, to give you a perspective, only 20 years back, we had over 20 manufacturing plants in the United States, from New Hampshire to California to Oklahoma to Midwest. And I said, manufacturing was moving to East Asia. I said, no, for us to maintain manufacturing in the United States, we have to rethink. We have to examine what we should do. So we said, we cannot operate 22 manufacturing plants. And I can even tell you some of the reasons. However, we said, what else should we do? So we went 20 years back to central Mexico, purchased, I think, a 50,000 square foot plant making leather upholstery, just cutting fabrics. Well, today it is 650,000 square feet making furniture, exactly the same that we have in North Carolina. We have almost 1 million square foot of operations of upholstery in North Carolina. All the fabric that even North Carolina utilizes is cut and sewn in our operations in Silao, Mexico, and shipped every week, almost three days a week to North Carolina. So combining this benefits of North Carolina is what makes it possible. Alone would have been very hard. Same thing, we went to Honduras about 12 years back, and we said we will have a wood operations there. But then we said we want to have it exactly the same as what we're doing in the United States. To do that, we decided that we would ship them every week our lumber from our lumber operations. We have major lumber operations in Vermont and in North Carolina. So every week, the lumber is dried in our kiln operations, shipped to Honduras. And today, the products that we are making is cherry and oak and pine and all of that. It's made in Vermont, it's made in Honduras. Combining the two is what is giving us an opportunity. So sorry. Let me just shut this off. So that is a very, very important perspective. Now, the other factor is the shortage of labor. When you talk of manufacturing in the United States, we have a shortage of labor. So we had to bring in a tremendous amount of technology, tremendous. Combining technology and good people is what made it possible for us to maintain manufacturing in the United States. For instance, our medical costs in the United States is a disaster. We're talking of having manufacturing in the United States, even in the president, I have mentioned it a few times. They should talk about our health costs. We can have easily sometimes a case that's almost $500,000 to $1 million in the United States. No such thing overseas, or no such thing in our operations in Mexico and Honduras. So there are a lot of factors. So I think combining for us, North America has been important for us. Without that, it would be very hard for us to maintain manufacturing. We would have done what others did. We would have gone mostly to East Asia.
Farouk, I'm curious, when you decide to bring more back to North America and bring more back to the U.S., what was the impact on your cost structure? What did it mean for pricing?
Well, keep in mind, it was not the fact of bringing back to North America. We stayed here. Very little went outside. We do have some manufacturing in Indonesia, not our plant, but we didn't go 20 degree overseas. We stayed in United States and then went to North America, like I mentioned, Mexico and Honduras. When we combine those two, that gave us a benefit. Otherwise, we would have had to go overseas like everybody else did.
Farouk, were you able, do you think, to make more here because of your business profile, Farouk? Because maybe you had certain advantages? Was it more efficient and easier to do because you were vertically integrated, Farouk, because you had a strong balance sheet? What do you think?
No, yeah, I think those are very important factors. One of the other important factor was that, again, 20 years back, in our wood products, almost 80% or almost 100% was made in stock. That is, we made the products, kept in inventory. We said no. We should utilize the benefit of our United States, especially United States and North America, and we decided that we will convert all our products into custom. Today, almost 100% of our furniture is made when we receive an order. Now, that gives a tremendous benefit. If the same product was made, say, overseas, the cost would be tremendously high. But because of the fact we are able to make it one at a time, if you come into our design centers, meet our designers, you can select any fabric from 1,000 fabrics. You can take any of our wood products, our chairs, and finishes and colors and sizes, and we make it all in custom, and we are shipping and delivering to our customers in about 4 to 6 weeks nationally. If you try to make custom products, say overseas, and bring it here, forget it. You're talking about months. So it's a combination of factors. If, for instance, we had said we would do manufacturing in the United States the same level as being done in East Asia, we would not be competitive. Combining our customization. The other factor, as you mentioned, is we are a vertically integrated company. We have one enterprise. We have the largest interior design network. And that interior design network gives us an opportunity of working with clients and providing customization of products all over North America. So the other thing we did, is again a part of it is, but 20 years back I said we will create one of the best logistics network of delivering furniture. You can get a lot of products from overseas, and by the time it comes here, all kinds of issues of quality, delivery. So we created one of the best logistics network and did something that was crazy at that time, which is we said we will deliver a product. We call it white glove delivery service, all done nicely at one delivered cost to a customer, whether they are in Seattle, whether they are in Florida, whether they are in Chicago or New York. People thought it was crazy. Today, if you come to a design center, you are able to get our products and it's delivered to your home with great service at the same price all over the country. Now, all of those factors gives us a major competitive advantage. Not easy. It takes a lot of investment, longer term thinking. If you're a short term thinker, you won't do these things.
Farouk, we're going to leave it there, but thank you so much for your time today. Appreciate it.
Government data just went dark, but money never sleeps, as they say. In today's Stocks in Translation, we're going to show you the playbook that keeps traders moving when the big jobs and inflation reports are on ice. And here are the major holes that we've got to fill. The BLS delivers not only the big monthly jobs report, but also inflation measures like consumer price and also producer price inflation. Meanwhile, the Census Bureau's retail sales, durable goods, and new home sales and factory orders, they're also on hold. Add to that the BEA, which calculates GDP, personal income and spending, as well as the PCE inflation gauge that the Fed likes. But there are more. The weekly jobless claims report is also going dark. Now, let's walk the proxies. On the jobs front, monthly private payrolls from ADP, it's a big one. In fact, we just talked to RSM chief economist Joe Bruce Willis on the Stocks in Translation podcast, and he said,
the Fed's got a much more difficult degree of landing because, believe it or not, the Fed gets a weekly update of the ADP estimate.
Oh, interesting.
They do. Most people don't understand that. So the Fed's not flying blind when it comes to the labor market.
There's also high-frequency shift data from Homebase, job postings from Indeed, and layoff color from Challenger. Then for prices and inflation, the Institute for Supply Management, ISM, and S&P Global both publish prices paid numbers, which help give direction. And online price gauges like the MIT Harvard Billion Prices Project, rents from Zillow, gas prices from GasBuddy, and e-commerce data from Adobe, together they help build a picture of price pressure. But Joe tells us that the Fed still has its work cut out on the prices front.
Inflation's a little bit more difficult. You know, they're probably going to be talking to the MIT Harvard Billion Prices Project and to get an idea of what's going on. There's a whole host of alternative data that we're all going to be talking about for the next number of years.
Exactly. And when it comes to spending and demand, we've got credit card spend from B of A and JP Morgan Chase, Redbook weekly same-store sales, and open table seatings. Then for manufacturing activity, there are the purchasing manager indices from ISM and S&P Global. And for shipping and logistics, we have the Cass Freight Index, reports from the Port of LA, Long Beach, not to mention TSA checkpoints. These are your week-to-week thermometers. But we also have market-based data that you can find through the tickers on the Yahoo Finance site, as well as the app. And for big indices, you can measure the S&P 500, the SOX, which is the Philly Semiconductor Index, the Dow Transports, as well as the NASDAQ Bank Index. Then for interest rates, we've got them across the yield curve, from the 13-week T-bill rate to the 30-year T-bond yield. And with volatility historically rising this time of year anyway, keep an eye on the VIX for stocks, the ICE B of A Move Index for bonds, plus OVX and GVX to measure oil and gold volatility, respectively. Finally, there are hundreds of new ETFs, and many of them measure wonky market stats. LQD and HYG measure investment grade and high yield corporate credit, for instance. And I like to take the price of IEF and divide it by IGIB as a measure of credit stress. When it goes up, that means investors are preferring the relative safety of US Treasuries over corporate bonds. So now you've got the tools, let's avoid the traps. First, focus on direction, not one-offs, especially with higher frequency releases on narrower data sets. It takes 3 prints minimum to make a trend. Then try to cross-check at least 2 independent sources. Are they saying the same thing or are they disagreeing? And always understand the methodology. Wonky things like sample bias and revisions can bite you. And finally, track the release times. Volatility will cluster around these drops, and the lack of big reports means that market seasonality itself will be affected short term. Bottom line, a data blackout doesn't mean you're blind, but until Uncle Sam turns on the lights again, we might have to work a little smarter. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Stay tuned for more market catalysts up next.
Cannabis stocks have been on a tear in recent months, rallying as industry-friendly headlines continue to roll out of Washington. The latest came Sunday when President Trump took to Truth Social to tout the benefits of CBD for seniors. And back in August, the Wall Street Journal reporting he was considering reclassifying marijuana as a Schedule III drug. Joining me now with his playbook for investing in cannabis stocks, Dan Aarons, portfolio manager of the Advisor Shares Pure U.S. Cannabis ETF. Dan, thanks for being here. We're seeing cannabis stocks double over the past 3 months, all on this hope of federal reform. But we've heard this story before, right? A lot of talk, not necessarily a lot of follow through. So what makes it different this time?
Sure. A lot of cannabis investors have had a hard time the last 5 years. When Biden was first getting elected, cannabis stocks went up a lot because Democratic politicians had promised a lot of cannabis reform, much like we had seen in Canada a few years earlier, and cannabis stocks went up an awful lot. Now it's been a long, painful wait, but a lot of good messaging coming out of the Trump White House and Trump himself. We're hearing a lot of good things that they are finally going to follow through with a rescheduling. Right now, cannabis is called a Schedule I drug in the United States on the DEA list, and they're talking about officially rescheduling it to Schedule III, and that would be a move between the HHS and the DEA. But we might get a executive order from Trump asking for it. Now, that doesn't put everything in place. We need Congress and we need the DOJ, but Trump can ask for it via a executive order. A lot of messaging that it seems like they can't really turn back on now, but many investors are still cautious after they have been burned so many times in the last 4 years with politicians' rather empty promises.
Yeah, and I remember 2018, 2019 being at Yahoo Finance, and that's all we talked about was cannabis stocks. Sure. And then we saw this steady years-long decline. I mean, you attribute it a lot to the lack of reform. How much do these names rely on that? I mean, are there other reasons to be invested in cannabis stocks?
Well, there's a big disconnect in the United States over investing in cannabis stocks. And even at the start of the episode here, Allie, Yahoo Finance put up the tickers and the symbols for Aurora and Tilray and Canopy. And those are all Canadian companies. They cannot have any THC cannabis business on the south side of the border. They have to keep that business in Canada, yet they are able to list on major exchanges in the United States like the NASDAQ or the NYSE. So our fund, ticker symbol MSOS, specializes in U.S. multi-state operators. Now, these companies are doing billions of business in the United States in states where they have medical cannabis dispensaries, or almost half the states in the United States now have adult use. But they're operating contrary to federal law officially. They have state approvals, and they are unable to list on the major exchanges in the United States. They are unable to do banking or custody with the major wirehouses and federal banks. They trade OTC in the United States. Now, our fund is the largest cannabis fund in the world, and it's a vehicle that's listed on the New York Stock Exchange. It is a place where people can get all those U.S. companies in one trade, and it's available through an awful lot of brokerages, but still not all because of this crazy U.S. federal law disconnect that we need to get this rescheduling. And our opinion is that rescheduling will then begin a domino effect where these companies could be custodied at banks, could have a safe banking bill, hopefully a pass through Congress, and be able to list on major exchanges, custody, and that opens them up to a great deal more institutional investment. we have the start of a movement to regain some of the losses of the last 5 years over the last few months, just on rumor and conjecture and messaging. We're waiting on an official announcement out of the White House anytime now.
And Dan, we only have about a minute here, but walk us through some of your top picks, the ones that are best positioned if we do see reform come through.
Certainly. Our top holding is Curaleaf, and that is a company that operates in a number of states, also in Europe, also has some hemp beverages. Another one is Trulieve right behind that. Real dominant force in the medical market in Florida, which is a huge market, also operates in a number of other states. A couple others in our top 5 holdings are Cresco Labs, another multi-state operator, and Verano, yet another multi-state operator. And again, these are quite different and a quite different opportunity than investing in those companies like Tilray, Canopy, and Aurora, and so on in Canada.
All right, those U.S. multi-state operators, that's what's on your radar. Dan, thank you so much. Hopefully we'll be talking a lot more about cannabis stocks with this recent rise. Appreciate it. Well, that's it for Market Catalyst. I'm Allie Canal. Thank you so much for watching. More Yahoo Finance straight ahead.